Today, I would like to present AbraSilver Resource Corporation, a silver and gold explorer in Argentina. First of all, I would like to briefly go over the reasons why I think it is still interesting to look into gold and silver for investments. I will then talk about why I think the silver miners are probably the best way to play this precious metals bull market. I will give an overview of the business of AbraSilver, go through the valuation, explain why I believe the opportunity exists, go through some risks, reasons to go long, the catalysts that are happening this year. And then at the end of the presentation, I have a few bonus ideas very briefly, other gold and silver miners. And then we have the Q&A. Okay, why gold? The reasons haven't really changed that much over the last 2 years, and you may have seen the slide in previous presentations of mine. So I'll just go over them quickly. So first of all, there's an increasing risk of a developed market debt crisis. And the perception also in media and in financial markets, I think, has increased that this is in fact a risk. We have many Western countries, but also some Eastern ones like Japan that have record debts and high deficits. In addition, very often we have even higher unfunded off-balance sheet liabilities, very often coming from public pension systems or from public healthcare systems. Politics in many countries has a limited ability to address the deficits and bring the debt load under control. And we could see this last year with the effort in the US administration that Elon Musk has been doing with his Doge department. And it was just after a couple of months, the political resistance was so big that it basically had to be abandoned. There's also an increasing number of developed countries where the government looks unstable and there's a distinct loss of trust in politics. As an example here, I would mention France, that has been changing its prime minister quite frequently over the past 2 years because the prime minister has been stuck in discussions on how to address the deficit. In addition, central banks have, over the last 2 years, increased the deficits because they have increased interest rates, and this, of course, compounds the debt at a higher interest rate. I think of particular interest in this case is Japan, because Japan, for a very long time, had extremely low interest rates, well below 1%, and now the 10-year, the yield on the 10-year Japanese government bond has crept above 2%. And if you have well over 200% debt to GDP, like Japan has, then your cost to service the debt increases dramatically. In addition, I think we'll also see structurally higher inflation over the next couple of years. There has been obviously an increase in trade barriers and tariffs, especially over the last year, with a lot of new tariffs introduced by the US administration. We also see that there's increasing efforts to reshore Western supply chains. Yeah? So the supply chains had been offshored over the last 25, 30 years to Asia, in many cases to China. And the reason for this offshoring was, of course, because it was much cheaper to manufacture there and then import goods to the West. Now, with the reshoring, even if you use a high degree of automation, these costs will increase. In addition, there are still, in some countries, especially in Europe, efforts with regards to the energy transition, reducing CO2 emissions. And this is increasing energy cost. Additionally, we have in many countries now sort of a central planning and regulations and subsidies instead of free markets in more and more areas of the economy. And this will, I believe, lower the productivity, unfortunately. In addition, demographics, I believe, could be a longer-term driver of structurally higher wages simply because the labor force is shrinking. And if you have less and less people available to work, then the price of the labor will go up. Since 2022, we have seen record gold purchases, mainly by non-Western central buyers. And we have also seen a lot of institutional investors that still have a high allocation to bonds, but a relatively low allocation to gold. However, over the last half year, we had several big US banks actually recommending significant allocations to gold, like one bank, I forgot which one, recommends a 20% gold allocation, which is unprecedented for decades as a recommendation from a big US bank. So gold definitely gets noticed. Now, why bother with silver? especially if you look at the price performance over the last year of roughly 150%, you might think, well, it's already too late. Yeah, the run is over and it will now drop back. But I would actually make the point that silver is not that expensive at $67 when I made the slide, or now it's above 70, but it doesn't change the picture that much. So basically, silver is still mostly below its historic CPI and M2 adjusted highs. If you look at the right-hand side on the table, yes, the nominal high in 1980 and 2011 was about $50. But if you CPI adjust these highs, you see that the high from 1980 would actually be close to $200 today, and the one from 2011 would be $71. If you look at the money supply in the US, M2 money supply, the numbers would be far higher, with more than $750 for 1980 high and $121 for the 2011 high. And my impression is that the M2 is probably a better measure, because many people, including me, would claim that CPI somewhat understates inflation. If you just look at the price of silver compared to gold, you can see that the gold-silver ratio at its low in the 1980s was at 16, and in 2011 at 32. And the low, of course, means that silver is the most expensive relative to gold. While now the gold-silver ratio at $67 an ounce is about 63, and the long-term average since 1971 has been 61. Yeah, so it's more or less at its average price relative to gold, and certainly not at the ratios that we've seen in past peaks. Silver has a high correlation to gold. And what is also very common in historic bull markets is that silver outperforms in the latter part of a precious metals bull market. And I think this is what we have been experiencing since April last year. In addition, it looks to me that the physical market is increasingly driving the price versus the futures market in the US. Especially out of China, I noticed that the price of silver in China is often several dollars per ounce higher than in Western markets. That means US and London. And as a result, there has been quite some flow of physical silver into China. And this, of course, drives up the global price in the physical market. In addition, in the last half year, there was a noticeable change in the US futures market. Normally, the futures market is just cash settled. Yeah, so there's never any physical silver moving anywhere. But over the last half year or so, there have been increasing demands from participants in the market who held long futures in silver to actually get physical delivery. That means they basically demanded from COMEX that silver bars get delivered out of silver warehouses of the COMEX into wherever the customer demanded they should be shipped, which warehouse. Okay, now why looking at silver miners? Silver miners, of course, have a leverage to the silver price. And what I notice is also that some silver miners and explorers are really historically cheap relative to the silver price. So I did a couple of calculations, and I would estimate that a lot of them are actually priced as if silver were below $40 an ounce. Especially the recent price increase in silver has really not been reflected in the silver mining and silver explorer shares. In addition, the primary silver mines are extremely rare. So if you have capital inflows in a silver bull market, these inflows are typically much higher than the initial market cap of the silver miners themselves. That means the share prices multiply, and an upside of a factor of 10 or more is very common historically. Also, we have silver mining projects that have periods of structural undervaluation during the life cycle of their project. And this is explained in the Lassonde curve. So the Lassonde curve is basically showing how the value of a single asset mining company changes over time as it develops an asset. Initially, of course, the value is very low because it has no gold or silver in the ground. So first it needs to do a discovery and find gold and silver in the ground. And in this exploration phase, the upside is very significant. So it's not uncommon to have, a very small exploration company with $20-30 million market cap move up 10-20 times to $700 million market cap as they find gold and silver, and they publish the first resource estimates, how much gold and silver is in the ground, and have the resources grow. This goes on for some time until the mining or exploration company says, well, we have now enough gold and silver on the ground. This is now economic to build a mine. And then the engineering phase starts. So the focus is no more on adding resources, but the focus is on doing technical studies and getting permits, in particular environmental permits, to be allowed to build a mine. But the engineering phase can easily last 5 years. It depends a lot on the jurisdiction. And in some jurisdictions, it's faster. In other jurisdictions, it can take even longer than 5 years. And investors who were investing in these early stage exploration companies, they typically leave for the engineering phase because they see, okay, there's no more resource addition, there's no more gold and silver found in the ground. And the engineering phase takes a long time, and there's really no catalyst for the share price to go up further. So very often, the share prices of these companies then goes down during the engineering phase. At the late stage, when the companies have done all the technical studies needed to build a mine, and they've received all the permits, especially the environmental permit necessary to build a mine, it starts to get interesting again, because then they organize the financing to build a mine, and afterwards they go into the development stage where a mine is being built. And developing a mine, in case of gold and silver mines, especially as long as they're open pit and in emerging markets, that may take 2 or 3 years. So it's a pretty quick timeline. And it is very consistent here that we see share prices move up by a factor of 2 at least, 2 or 3, depending on, of course, if it's a precious metals bull market or not. And the probability that the mine is built after they have received all permits and after that they have received financing is very high. It's typically over 90%. Okay, now let's look at Abra, the company I'm presenting, and where they are on the last sort curve and what assets they have. They basically have 3 places on the last sort curve. One is an open pit deposit that is in late stage engineering. The company is currently working on its definitive feasibility study, which is the final technical study needed before a mine can be built. They expect to have this study completed in the second quarter this year. In addition, this asset is still in exploration, so that is very unusual. So they are still doing exploration on that deposit, and they continue to find more gold and silver and significantly grow the resources in the ground. That is why I put a second star in the exploration stage of the curve. And then they have a second project in another province where that is very early stage, where they have a collaboration with Anglo-Teck. And this is a potential copper gold deficit, but it is so early that it's hard to say how it will play out. The strategy of the company is basically to continue exploration in parallel to develop the first mine going forward as soon as they have the permits and the financing, and then use the free cash flow from the first mine to do even more exploration. So you basically get, if you invest, you get the value uplift from the last sort curve for the development phase, and you get also the uplift from the exploration part of the last sort curve. Now I mentioned the company is based in Argentina, and its assets are based in Argentina. Argentina has changed dramatically over the last 2 years in terms of investment attractiveness, especially for mining. The reason for this is because Argentina introduced investment incentives in summer 2024. And I will briefly go through the main one of them. So, for instance, they offer a lowered corporate tax rate of 25% versus 35% previously. They have also eliminated the export duties for gold and silver, and these were dramatic. Yeah? So if you had a gold or a silver mine in Argentina and you wanted to export the gold and silver, you had to pay 8% on gold revenue and 4.5% on revenue from silver. And this is, of course, a massive impact on the profitability. To make it worse, historically, you had capital control. So it was very difficult once you had invested in the mine was producing cash flow to get the cash flow out of Argentina. This has now been much improved, and it's to a large extent now unrestricted to get cash out. And in addition, they offer accelerated depreciation of the capex, and they also have long-term stability agreements which basically fix the taxes and other rules for 30 years. Yeah? So it makes it, from a legal perspective, much more safe. It's not like, yeah, maybe a new government comes in 2 years from now and they decides to completely change all the rules on the taxation. If you then look on the right-hand side of the slide, we see that with these incentives, Argentina becomes very competitive compared to other big mining countries in Latin America. So we see that Peru, for instance, has a 29.5% tax rate, Mexico 30%, Chile 27%. And also the royalty rates that the government gets from the mining companies are much higher in Mexico, Peru, and Chile compared to Argentina now with these new incentives. So I think Argentina, if they can keep this framework, will have a lot of investments from mining companies. Delving a bit deeper into the company itself,